This is a short summary for a module on short selling. I hope you found it interesting. Short selling, as I'm sure you've come to realize, is not simply the opposite of doing long research on a stock. It's looking for nuances, and if it's obvious that there's a problem, the stock's already down. So it's looking for things that others haven't discovered yet, for the most part. The risk in short selling is quite high. If you short a stock at 10 and it goes to 20, you've lost 100%, and it can keep going. If you buy a stock at 10 and it goes to 0, that's all you can lose. So there's a risk difference between short selling and traditional and long investing. If you pair up the longs with the shorts, you can mitigate much of the market movement and market risk, but it's still not perfect. They won't correlate perfectly. I started short selling with this firm called Feshbeck Brothers in 1989. I know it's a long time ago, but it grew to be $1 billion short fund while I was there. When the first Iraq war started and the bombs started dropping, which to me was not actually good news overall, but it was good news for the market. It meant that uncertainty would be resolved, and the market took off. That $1 billion short fund lost 40% in 6 weeks. And if you think about the mechanics of that, it started out being fully invested, basically $1 billion in equity. You could liquidate the fund and get $1 billion, and $1 billion of exposure, of short exposure. When the market took off, the value of the stocks that it was short became $1.4 billion. That's a big change. But it's certainly something that can happen when a stock market rallies and the stocks that you're short have been beaten down. You'll see that kind of move, especially if they're smaller companies, and we had a good number of small companies. At the same time, the companies that you're short have become worth 40% more, $1.4 billion. The value of your fund is down. It was $1 billion. You lost $400 million. Now you've got $600 million in equity. If you close shop right now, you got $600 million. That's very bad, because now you have $600 million and $1.4 billion of market risk. That means you have to trim back. A margin call is on the horizon. Your investors are unhappy about the risk profile that you have, as they should be. So it's a very interesting area. It's different. You won't find a lot of courses on short selling. It's a bit obscure, and yet hedge funds have become very popular, and the purpose of a hedge fund, at least at the origin, was to hedge market risk out. I hope you found it interesting, and I look forward to discussions on other topics as well.